Hi, my name is Philip and I'm with Carmichael Hill, and today we're going to be going over tax loss harvesting and how you can apply it in your individual lives to potentially lower your tax bill. Let's get to it. In this video, we're going to break down tax loss harvesting, then we're going to go over a few basic rules, and we'll wrap it up with some applications. So what is tax loss harvesting? It's really just a fancy way of saying offsetting your investment capital gains with your investment capital losses to ultimately reduce your taxable income. So let's go over a few rules of tax loss harvesting. Rule number 1 is tax loss harvesting can only be done in taxable accounts. Right? So this might be like your individual account, or if you're married, you and your partner might have a joint account. That's where tax loss harvesting comes into play. Tax loss harvesting cannot be done in non-taxable accounts like your traditional IRA, Roth IRA, your 401ks, things of that nature. Rule number 2 is the wash sale rule. So this rule, it basically prohibits the use of any harvested capital loss if you purchase the same or substantially identical security before or after 30 days of sale. So for instance, if I had Google and I realized it had a loss and I wanted to harvest that capital loss, I could sell Google, but I can't buy it back within 30 days. I have to wait up to 31 days or more is when I can buy it back and actually use the harvested capital loss. So now we're going to go to rule number 3. The IRS only allows you to claim up to $3,000 of capital losses per year. So you might ask yourself, well, Philip, what if I have more than $3,000 of capital losses? Well, let's do a quick example. Let's say you have $100,000 in your individual account of losses and you want to harvest it all. You can completely do that. So now you have $100,000 of capital losses. Unfortunately, the IRS only allows $3,000, right? There's a cap. So you can take $3,000 of that and harvest it. The remaining $97,000, that can be then rolled over or carried over into the future years for tax purposes. And it's indefinite, so it doesn't expire. However, like I said before, there's a $3,000 cap, so no more than that can be used for one given year. Last but not least, we're going to go over rule number 4. There's 2 types of capital losses or gains. There's a short-term. We have short-term. Short-term loss is any security that you've held for a year or less. So 1 year. So if I have Google and I decide to sell it for a loss in 5 months, I've had it for a year or less, that's going to be a short-term loss. A short-term gain, let's say I sold Google for a gain, that's also going to be taxed at ordinary income rate, so that's a big note to keep in mind. So short-term gain is taxed at ordinary income rates. Right? Now there's the long-term loss. And you probably guessed it. This is a security that you've held for a year or more. And another thing to note, a long-term gain, once again, if I held Google for more than a year, and I decided to sell it and realize that gain would then be taxed not at ordinary income, but it'd be taxed as a long-term capital gain, which is either a flat 0%, flat 15%, or a flat 20%. It all depends on your income. All right, so now we're going to go into tax loss harvesting, what we've all been waiting for, right? As you can see on the board, we have 5 different positions. 1, 2, 3, 4, 5. You can make up whatever positions you want in your mind. This could be Google, Tesla, Netflix, however you'd like it. So let's say in position 1, we have a $3,000 gain. In position 2, we have a $5,000 loss. Position 3, a $2,000 gain, $4,000 loss, and $5,000 gain. Let's say in position 1, we realize that this is a volatile stock and we're just happy to be up $3,000, and now we want to sell maybe 2K of it and enjoy some of the gain. By the way, all these holdings have been in our portfolio for a year or more, so what? They're going to be taxed as a long-term gain. So let's say we close $2K out of this position. So we have a $2,000 realized capital gain. And we see a position over here that's worth $1,000. It's small. We're just ready to get rid of it. Plus, we need to rebalance our portfolio and get us back into our asset allocation recommendations, our parameters. So we're going to sell off this 1K and realize that $1,000 capital gain, totaling us for a $3,000 capital gain for the year. If we did nothing else at this point, we'd be taxed at long-term capital gains rates for $3,000. Now, to offset this with tax loss harvesting, you also recognize we have a $5,000 loss and a $1,000 loss. So let's say when we sell off $2,000 of this position here, we got 2,000, and we sell off this small loss. We don't really see any potential of this stock going up anymore, and we take this out. That leaves us with now a $2,000 capital loss and a $1,000 capital loss, totaling to $3,000 capital losses. So if you take the $3,000 of capital gains minus the $3,000 of capital losses, you're then left with zero, which is how you reduce your income and you would pay no taxes on. Now you might ask me, why would I just want to sell off winners for losers? One, it's to reduce taxes, but two, like I mentioned earlier, if you have any rebalancing purposes, this would be a great example or a great way for you to rebalance your taxable portfolio, your taxable accounts, without incurring any big tax bills, because as we know, your taxable accounts do, when you make sales, it does trigger a taxable event. So now let's give one more example. Let's say we looked at this and we decided we wanted to take out this whole entire loss. Instead of 2K, we wanted to shed it all off, close it down. That takes that 2K loss now to a 5K capital loss. So 5,000 plus our 1,000 loss would have us at a $6,000 capital loss. So if we take our capital gains that we took off and closed out $3,000 of capital gains, and now our $6,000 worth of capital losses, we're then left with $3,000 of harvested capital losses. This is where the carryover rule applies. We can only take $3,000. So the first $3,000 would be used for the current tax year. The remaining $3,000 would then be carried over into future tax use, and it can be used indefinitely. There's no expiration, so that's the good part about that. I hope this helps. I hope you've learned a little bit about tax loss harvesting. See you soon. Until next time.